Roger Montgomery from the Montgomery Fund. Thanks for joining us.
It's good to be here, Mark.
Massive amount of talk in the media, the toing and froing on a daily basis about are we or are we not in the property bubble. Real estate industry and the banking industry saying one thing and other economic commentators saying another.
We'll never ask a barber whether you need a haircut.
Yes, indeed. What do you think?
Well, I think there's two parts to the answer of that question. In the short run, the property market is just like the stock market. It's a voting machine, so popularity drives prices. And at the moment, it's trendy and popular to buy property because, hey, it's going up, and people jump on board. And in history, throughout Australia's history, we've been wedded to this idea, well, certainly since the 50s, we've been wedded to this idea of property ownership. And that's been fueled by successive governments. So John Howard, for example, handed out $7,000 for a first home buyer's grant, and then it was $14,000, then it was dropped back to $7,000. Now imagine what would happen in the stock market if John Howard had come out and actually suggested that every Australian is going to get a $14,000 first share portfolio buyer's grant. Share prices would have gone through the roof. But would they have stayed there? Probably not. The problem with property, or the advantage of property, is that there's so much emotion invested in the property purchase and so much debt tied up to it that people don't flip the properties as much as they buy and sell shares. And so you don't see the volatility in property prices as much as you do see in the share market. Classic example, during the GFC in a suburb in Sydney, Mossman, there were streets where, I'm not exaggerating, 2 out of every 3 houses were quietly on the market.
Wow.
At prices that were 30% below where they'd last traded.
Yep.
Now that's a crash in anyone's language.
Absolutely.
And yet we survived that, we've gone through that, and it didn't disrupt. So in the short run, I believe that we'll see prices, there is a risk that prices could pull back, but I don't think we're going to get a panic because you need everybody selling en masse to get a panic, and for the reasons I've just described, no one's going to be selling on, you're not going to see that en masse selling. In the long run, however, my view is a bit different. I think the majority of property is owned by and paid off by baby boomers who are now approaching or in retirement. There will come a point, and we're seeing a lot of stories about people being underfunded for their retirement. They're going to be forced to sell their properties because a large portion of their wealth is invested in their property. Who are they going to sell to at these high prices? Well, the generation underneath them is crying poor and saying they can't afford to pay these prices, but that's the generation, they're the people who are going to buy these properties. So unless we see massive immigration and a big increase in the population of Australia, or we see a lot of foreign investment, a lot of foreign purchases of properties across all the price points, then you may see, if not a decline in property prices, a failure of property prices to increase at the rate they've increased before. And what we know over a study conducted in Holland, or Amsterdam rather, over the last 360 years, is that property prices, and it was a 360-year property price study, property prices track inflation, but in Australia there was a disconnect around the 1950s and property prices started tracking incomes. But over the long run, and that's followed the wave of baby boomers, building their homes, upscaling, and maybe even downsizing down the track. But it'll track the baby boomers, and I think that means the price growth that we've seen over the last 20 years or 30 years, we won't see that again. It'll be more muted.
I think that's really good analysis, and thanks for your time with that, Roger. And for more insights from investments to property to shares, stay tuned to our website.